Good morning. Thank you for joining us this morning. So my name's Simon Wicks. I'm the CEO of Butler Rose. Hopefully a few of you know me and certainly know of Butler Rose. So thanks for joining. We're going to be doing a live webinar this morning based around the subject of accounting for a COVID-19 year end. We've had about 150 people sign up this morning, so great to see you all here. If you are in the audience live, then you are on mute and your video is turned off, so you won't be able to interact with us in that way. However, you can type into the live chat function. So if you have any questions this morning, please type them in as they arise. We're going to be splitting the session this morning into 3 segments, so we'll try and do a brief Q&A at the end of each segment. That said, we should be keeping this to around an hour. So if you type your questions in as they arise, and we'll get through as many as we can this morning within that time frame. Now, it's certainly been a strange year. I think that's an understatement, I would say. So it's hard to believe that just a year ago we were going about daily life as normal. Everyone was going off to work normally. Didn't really know what lockdown was, apart from things that we were starting to hear about in other parts of the world. However, things have changed a lot, and it's probably fair to say that few professions have been affected quite as much as the accounting profession. We've had things like the CJRS and the various tax reliefs and deferrals and loan schemes all rolled out by the government. Quite a lot of information really for finance professionals to get their heads around in quite a short space of time. So we thought it'd be good to get some expertise in to have a chat with you this morning. There's obviously been quite a lot of information around these things disseminated before, but with tax year end coming up and financial year end coming up for many and year end audits coming up, we thought it'd be a good idea to do a bit of a recap on getting through your year end and certainly your audit as well. So I'm delighted to say that I've got a couple of guest speakers that joined us this morning from RSM. So we've got first of all Ben Lawrence, who is the Regional Audit Managing Partner.
Hello everyone, and thank you for attending today. Hopefully you will find this very useful. I'm the Regional Audit Managing Partner of our central region in RSM. I'm also an audit partner and sign off audits regularly throughout the year. So what we're trying to do here is have some practical implications on accounting, but then I'm going to give some hints and tips in relation to audit. Rather than being detail, it's about how I can suggest things to you to help your audit go smoother. I'll now pass you over to Paul to introduce himself.
Hi everyone, my name is Paul Morris. I head up something called Financial Reporting Advisory here at RSM. Within Financial Reporting Advisory, we give advice directly to clients on accounting standards, whether that be IFRS or UK GAAP and the Companies Act. So we've been here for 8 years. It's effectively a technical department directly for clients. Without further ado, let's make a start. So thank you and welcome to you for joining this presentation. As Ben just said, we're going to focus on the practical aspects of the implications of coronavirus, whether that be from the accounting point of view or from the audit point of view, and we've got some audit hints and tips. And this is based on what we found over the last few months, what's really been affecting people and what people have been finding difficult. So on the agenda today, we've got a relatively short agenda, but the really key areas of what are affecting people and what you need to think about for your upcoming year ends. So starting with going concern and impairment, then looking at governance assistance and the different forms that have been given, directors, strategic and audit reports, and then finally just have to think about audit pricing and tenders. Next slide, please. So to start off, we're going to have a look at the going concern and impairment, and they are some of the really difficult areas. But before we get into the onerous aspects of it, there is some good news. There is at the moment an automatic filing extension for companies which are finding it hard to get their year-end accounts done within the normal timeframes. And this is a 3-month extension. Which is automatic, you don't have to apply for it, but that automatic part of it runs out on the 5th of April 2021. The FRC have said that after that you can still apply for an extension and it will be given, but it would be an application process rather than an automatic procedure. If you are doing the filing extension, it is necessary to think about some of the other exemptions and what the impact may be on them. First of all, the audit exemption, it requires you to file the parent company's accounts before you file the subsidiary accounts. So if you're taking the extension for the parent company, you will have to defer the filing of the subsidiary accounts as well. Similarly, for the consolidation exemption for intermediate parent companies, they are dependent on filing the parent company's accounts within the filing deadline. So if you take that extension, it may mean that you have to do consolidations at lower levels down in the group. Next slide, please. Oh, sorry, can we just go back? I just missed one point on that slide. The other thing to think about is your banking requirements. When taking those extensions, it's necessary to consider your covenants, because they may say that you have to file your accounts within a certain amount of time, and you don't want to be in breach of covenants just because of the current situation. So it's necessary to just think about, have a read through those bank loans and just make sure you're complying with all those requirements as well. Next slide, please. So one of the most onerous things under the current circumstances is the going concern assessment. FS 102 says you have to make an assessment of whether there's an ability to continue as a going concern and adopt a going concern basis unless there is an intent to liquidate, there's an intent to cease trading, or there is no realistic option but to do so. So there's very much a bias towards preparing accounts on a going concern basis, which is in conflict with that assessment, and the way in which the account standard deals with that conflict is via disclosure. And it says you have to give disclosures about all the material uncertainties that you are faced when you're making that assessment, and also the significant doubt, where there is one, over the going concern status. Those uncertainties and judgments will need to be more extensive due to the coronavirus situation. The reader of the accounts will want to understand what is happening and what is the impact on the future and how that is being affected with what's going on in the world. This is one of the areas which is causing lots of problems in accounts, because how much do you say and how much you don't say, and what are the relevant facts to the reader of the account is really difficult to put across. So it's an area where, when you're drawing up your accounts, quite often going concern and disclosures relating to it are left to the very last part of preparing your accounts. Something which is worthwhile giving some thought to early, just to make sure that you've covered all the necessary requirements. There's also a belief within the Corporate Insolvency and Governance Bill over trading wrongfully or trading insolvent, in that it's reduced the personal liability associated with this. This was originally given during the first wave of the pandemic, and then it was extended to the 5th of April 2021 in the second wave. We haven't seen any extensions beyond that point in time. So it's something to watch out for. If you are in that sort of situation, seek legal advice or talk to an insolvency practitioner, just to make sure that you're not putting yourself as directors of the company into danger. Next slide, please. The other big area which really takes a lot of time at the year-end process, which isn't normally giving enough priority under normal circumstances, but under the current circumstances is even more onerous, is impairment. Due to the current state of the world and the downturn in some businesses, impairment is likely to be a much bigger issue. And that will be affecting things like intangibles, goodwill, property, plant and equipment, and investments. What the accounting standard says is that you have to look for an indicator of impairment before doing anything. Well, the pandemic itself may be such an indicator, so you may not have to look any further. Where there is an indicator of impairment, it is necessary to then calculate the recoverable amount. The recoverable amount is the higher of the value in use and the fair value less cost to sell. Where that is lower than the carrying value, an impairment is booked to bring it down to the recoverable amount. Some companies adopt a valuation process for their PPE and keep their amounts on balance sheet at their current values. Under the current circumstances, they may be more difficult to calculate, and it may be necessary to engage an expert to do those calculations for you. Also, it's necessary to consider the position for current assets, so your stock, your trade debtors, your intercompany balances and things like that. Stock is recorded at the lower cost and net realisable value, with stock possibly being slower to turn around, or different ways of the world operating may actually become impaired sooner. There might be greater provisions against stock. Similarly for trade debtors, there may be a greater need for provision for debts, and similarly for intercompany balances. If you have a subsidiary which is struggling to trade under the current circumstances, it may be necessary to think about whether, if there is an intercompany receivable within the group, whether it is necessary to book a provision against that. In which case, I'll hand over to Ben, who's going to talk through some of the audit implications of those areas.
Hello. So I just wanted to pick up on going concern and impairment on an audit side of things, and Obviously, you will have gone through this already with your auditors, probably last year, but I just wanted to reiterate some of the key learning points that we're finding in our clients. So the first bit really is, why does it take so long? It is hard, and as you will see later on, there are some new requirements that make this even harder for auditors to sign off. And I'm hopefully will give you some stuff that shows you why that's the case as we get towards the end of the presentation. But how can you, as finance professionals, make this easier for your auditor and therefore easier for you to get through this bit, which is probably what caused delays in your accounts last year? So I've just put down here a few bits to go through. It's management's view in terms of going concern that the auditors have to review. So if you can not only put a forecast together, which has balance sheet, cash flow, income statements, as I would expect you probably have already for at least 12 months from when you're going to sign, if you could put together a paper around it, a narrative paper that discusses why you believe you're a going concern, that will help the auditor immensely to see some words and understand what's going on. One bit that people are tripping over and continue to trip over is things like parental support. The auditor can rely on parental support to some extent, but they will need to see those numbers. So make certain they're available for them on day one rather than having to ask. And if you can deliver all these things early and upfront, that will help. The covenants and everything that's in place in relation to that side of it, make certain they're in your forecasts for the whole review period and that they all work. It sounds obvious, but the amount of times I've seen forecasts that don't have them in or they don't work, and then clearly you're just going to get challenge. Spreadsheet errors, it seems obvious, they're quite frequent as well. So get maybe one of your teams check the spreadsheet for you, just making certain that there's nothing in there. Disclosures themselves that you put into accounts can be quite weak and don't necessarily always tie into the narrative paper. You'll see a lot of examples out there now. The wording in the accounts is much more fuller than it ever has been and will continue to be, as you'll see. And then probably finally is there's no worst case or sensitivities done. So if you can pick all the above, put some sensitivities in, a 10% reduction in turnover or a particular contract lost or something that might happen out there, that will certainly help your auditor to see where you're going concern and hopefully make that review a lot quicker and easier. And as I said, as you'll see later, this is becoming a lot harder for the auditor to sign off. In terms of impairment, again, you will have done this before, but just it's the hints and tips about how you can get this better. So make certain that you've got support for the discount rate you're using in the impairment. Set out those income generating units. So whereas the going concern work that you will have done is for the whole company, what you'll find in terms of impairment, you might have to split it into the income generating units. And a lot of people miss doing that. Make certain that you have available the assumptions and underlying data. And again, document and write why that is. If that's already and upfront, along with going concern when the audit starts, it'll be much smoother. And I think the main tip really is treat this as you would do any other deliverable for the audit, along with going concern. Have it ready on day one. That will make your whole process simpler rather than waiting till the very end. The reason for that is this is harder and it is going to increase cost. And you probably had some overruns last year, but if you deliver this to your auditor, this is going to be much easier for you and potentially save cost. I will hand you back over to Paul.
So we have got a slide here for if we have any questions on that topic before we move on to the next one. Not sure, Simon, have we had any questions come in?
We don't have any questions at the moment, so if you do have any questions, like I said earlier, then feel free to type them into the chat function at any point. If you wanted to move on to the next part, Paul, then feel free to, and we can maybe do some questions at the end of the next section.
Of course. So this next section is on government assistance, and it's been in various forms of job retention scheme or loans and things like that. And each of those have a knock-on impact on the accounting, but also have an impact on how the audit process is run to check those schemes and extra things to think about. So we start off having a look at the job retention scheme. This is where the government, where staff are furloughed, are paying up to 80% of their salary, so, up to a certain cap. From an accounting point of view, it is a government grant. As a government grant, it will be shown separately in the P&L account as other income, i.e. it's not turnover, it will be there as other income and further down the profit and loss account. The way in which it is measured in FS 102 for government grants is between a performance model or an accruals model, which is a choice of which accounting policy is chosen. For the purposes of this scheme, it wouldn't make any difference because the money is earned at the same time as it is expended and the cost is incurred. So both the performance model and the accruals model give the same answer of recognition as you incur the expense and you recognise the income alongside it as other income. But the one thing which you do have to check is whether it is certain that you're going to get it. So is there reasonable assurance that you will comply with the conditions of the grant and that the grant will actually be received? Where that is the case, then you do recognise it. It is necessary to think about disclosure of the account policy, so that has to be in the accounts, and to give disclosures on the nature of the grants and the amounts of grants received. Also, there's no netting off, so you can't net off the receipt of the grant against the expenditure received, the expenditure paid. So you have to present this separately. It is a separate line in the other operating income, and it will be visible in the accounts, and those extra disclosures mean that the world does know that you've received that grant. Next slide, please. The other area of government assistance is on business loans, and this first slide looks at the business interruption loan scheme together with the bounce back scheme. I won't go through the actual details of the scheme and who can apply for them and when they apply, as we could probably spend the whole hour talking about those. But the basic principle of the scheme and the biggest impact on the accounting is that you get interest-free payments for the first 12 months. And also there's a guarantee over the lending for the borrower. So the two main features. As there is a release of the 12 months payment of interest, this is a government grant. It is a gift from the government to the company. And as such, the same things apply as for the job retention scheme. They have a accounting policy choice between performance and accruals model, but again, it doesn't make any difference because it's being earned as you expend the money. So the recognition is over the time, which you'd normally incur the interest expense. The way it's presented in the accounts is that you have to calculate the interest on the loan throughout the life of the loan, and you build that up over time as you normally would, including the finance fees up front on the loan. That interest expense is still recorded in the first 12 months, but you are also showing a government grant in other income. Similarly to the job retention scheme, there's disclosure required of the form of the assistance given, the amount of the government grant, and what your accounting policy is. The other scheme which I wanted to talk about is on the next slide is the Future Fund scheme. The Future Fund scheme is for companies which are slightly higher risk than the business interruption loan scheme, and it applies to people which are requiring loans of between £125,000 and £5 million. The main difference with these loans to the other ones, though, is that there's a conversion feature which kicks in at various points in time to convert into a number of shares. So the loan actually can be settled under such circumstances into a number of shares. This makes the accounting quite complicated, as there's a decision as to whether or not that conversion feature is an equity element of the loan, and so you would have to split out the equity and the debt components from an accounting point of view. If they thought to be debt, that isn't the end of the story, unfortunately. Under UK GAAP, you would have to consider what the implications were for recording that loan and whether the loan is recorded at cost or at fair value. And the list of criteria to determine that is quite massive. First of all, you have to look at the accounting standard FS 102, but then you have to consider the requirements for fair value under the Companies Act, which then refers to IFRS. And so the list is probably 2 or 3 pages long of things to consider before you can determine what the correct accounting is. And it's a similar thing for IFRS accounts as well. You have to consider there whether there's an embedded derivative which needs separating out and fair valuing, and you end up with very much the same point of consideration. The accounting is different because it's only the embedded derivative that's fair valued rather than the whole loan. But this is an incredibly complex area. So if you have entered into a future fund scheme, it's something which I suggest you talk to your advisors as soon as possible about how you calculate it and what valuations you might need to get. Next slide, please. I'll hand you over to Ben, who's going to talk about the audit parts of those.
Thank you, Paul. The future funding one clearly is quite complex, and you will need advice on that in terms of how you account for that and the debt equity split. But when you're looking at something like CBIL loans, they're like any other loan except for how you account for the fees. So there's nothing to get too worried about there, but clearly it will have an impact in relation to going concern. The big issue here is a lot of companies managed to get their going concern sign-offs probably last year because they've just got a CBIL loan for £1 million or £2 million or something. Clearly that gave a big chunk of money that businesses had in terms of their forecast. This time round, when you do your going concern, this is going to be the bit that I think might cause some companies more issues, because will they be keeping the loan? Have they spent the loan? Where are they at? And they haven't got that big chunk of money, and this is going to make it a lot harder. So please make certain you're factoring that into your going concern work as well. The job retention scheme, on the face of it, seems very straightforward. And you think, well, I've claimed some money. This is great. Probably didn't realise until now that it goes in the face of your income statement. So that might be a bit of a shock. And actually, to some clients where it's a big number, that probably is a shock. If it's a small number, people seem to be less bothered. But where it's a big number, that's going right on the face of your accounts. So take a scenario where you go, you've put in £1 million of furlough claim, and you've got it. And your profit last year was £1 million. Your profit this year is £3 million, yet you've had the £1 million. There's going to be some questions asked there, potentially, from people looking at your accounts, a bit like the Tesco's and people like that, where they've paid back things. So do have a think, if you're making profit, what's going to be seen in your accounts, and are the board happy that they understand that disclosure is going to be there, and are you paying it back or not? Now, clearly a lot won't, because it has done what it was supposed to do, which is save jobs, but some are. Now, if you're paying it back, that can make the audit process a lot easier, clearly, because then you've paid it back and you can disclose that and everything else. If not, the question will be, is it material? And if it's material, you've then got some issues here in terms of what the auditor needs to look at. And like anything else, get your auditors to look at this as early as possible. Now, the problem we're finding with this scheme is there were in excess of 100+ pieces of legislation and advice that came out in relation to this when they came out. It was very hard, as you will have known, to actually do this when you were going through it. You've now had 2 or 3 different phases and different rules for each, where you've got part furlough, full furlough, everything else. You've got a lot of employees that may be on it or going through it. The problem can be, if the auditor finds an error on your first claims, the chances are it's a systematic error and can very quickly escalate up to quite a big number. You've also got the penalty regime that can be up to 100%. Now, I don't want to scare people here, but ultimately nobody knows what that's going to be in terms of what will actually come out. We have experience when it comes to tax penalties, and we have experience of other penalty regimes. This is brand new. What will they actually do in terms of the penalties? And if you find errors, obviously you're going to have to potentially disclose them. So the main message here is, please, please, please look at the job retention scheme early on. Get someone to check it in terms of your auditors, in particular if they're going to sign an audit off and it's material, and then you have a chance of trying to solve any problems that may come up. A lot of those problems can be solved, but please just be aware that you do need to be on top of this, because it can be a big material number to your accounts. That was all I had to say in terms of audit hints and tips. I don't think any questions have come through, but if anyone had anything, please do type. I'll just wait a second, and if there's anything at the end, we can then pick it up there as well. Okay, Paul, over to you.
Yeah, please go to the next slide. That'd be lovely. So in this section, we're going to look at directors' reports, strategic reports and audit reports, and think about some of the implications for the front end of the reporting. One of the things which is getting increasingly more difficult is the narrative reporting at the front of the accounts, which has been around for a number of years, but that has become a lot more onerous in recent years with the extra requirements that have come in. This is made even more complicated by the current state of the world and what's happening with it, and what's necessary to disclose in each of those areas and think about. So we can start off having a look at the Director's Report and Strategic Report's recent requirements and how they impact different types of company. So the first one, which come in on the 1st of January 2019, so this will be the second year of application of it, is the requirement to have a Section 172 statement. This statement requires directors to disclose how they've applied the principles of Section 172 within their accounts. And there's broadly 6 principles within there. So long-term decisions, how employees are affected by the business relationships, community and environment, the reputation of the business, and the factors that the directors over all of those principles have to act fairly and how they demonstrate that alongside those principles. This is going to be impacted in each of those areas by what's going on in the world. So the employees' disclosures will be impacted by the furlough scheme, the business relationships and the payment of creditors and things like that. The long-term decisions will have been greatly affected by how the business is changing, whether it's positive or negative. So something which is going to require a lot more thought given the current environment. Similarly, within the director's report, there's a new requirement, or 2 new statements being required for the last couple of years. One about business relationships with suppliers and customers, and how directors have engaged with employees. Similar to the Section 172 requirements, they are going to require some extra drafting due to the current status. Both of those requirements apply to large companies. There's an extra requirement on Section 172 looking at gross assets and the number of employees, but for anybody large, those 2 new requirements have come in. The other 2 areas are for much bigger companies. So the first one is the weight requirement, which is about corporate governance, which came in on 1st of January 2019 and applies to very large companies, so ones with over 2,000 employees or turnover of over 200 million, or balance sheet total of over £2 billion. So very large companies. Under those, a bit like listed companies have had to do for many years now, you have to talk about how you apply the principles of good corporate governance. And they've broken those down into various categories of 6 principles. But again, those principles will be affected by the current world, and it'd be necessary, rather than just being able to roll forward those disclosures, it'd be necessary to think about whether there's something to say about those principles and how things have been changed by the current environment. Finally, energy and carbon reporting requirements have been in place for quite companies for quite a while, but are also now affecting large companies and large LLPs. There is an exemption for companies which have got less than 40,000 kilowatt hours, but otherwise these disclosures are required. And they cover things like the level of emissions of CO2 from various sources and the total consumed energy in the UK and things like that. They are very extensive and very difficult to calculate. This year there's going to be a lot more to think about because they're not going to be the same type of numbers as last year for many companies. Quite often people will have normally had all their office expenditure and things like that within there. This year, with people working from home, those numbers are going to change quite drastically. So a lot to think about again within the energy and carbon reporting. I'll hand you back to Ben.
Thank you, Paul. Before I talk about the audit report bits, I just wanted to flag on the director stuff that Paul's just talked about. Some of that stuff is not new for some of you if you've been doing it already, but there's a massive change coming, I think, which is it's a direction of travel. It's also, in terms from an audit point of view, it was a bit of a soft landing in terms of the audit piece there. So when you have your audit going on, it's a new legislation, it will have been a bit softer. But now, unfortunately, as the audit continues, this legislation will get harder to do, and you'll be expected to do more and more and more, and there'll be more experience, more things out there in the marketplace. So if I move on to the audit report piece, there are 2 main changes here, which I think are quite important for people to understand and actually help you realise why this is a harder year and why the costing is it is. There are 2 big changes in relation to going concern and irregularities, including fraud. And you might think, well, why am I telling you? Why I'm telling you is because the emphasis that the auditor has is much higher than it ever was before. And the best way to show this, as weird as it sounds, I'm going to show you some potential things that might fall into your audit reports. It's very similar to what's happened with listed companies. So going concern. Based on the work we've performed, we have not identified any material uncertainties relating to events or conditions that individually or collectively may cast significant doubt on the company's ability to continue as a going concern for a period of at least 12 months from when the financial statements are authorised for issue. Now, if you stand back from that, that is a very, very hard statement to make. And your auditor, in the case of if I'm signing something, me, has to put their name to that statement for your business that they don't run. That is much, much stronger than we had before. And therefore, the emphasis on getting going concern much more detailed is much, much higher. And hopefully, now you can see those words, it might make a bit more sense in terms of why people have been talking about going concern so much and why it's harder. The unfortunate bit is these were coming in pre-COVID, and now with COVID as well, this just makes it even harder. This is another example of something that might happen. I'm not necessarily going to read all of this out, but it talks about irregularities and non-compliance with law and regulations. And it says that the objective of the audit is to help identify instances of non-compliance of law and regulations that might have a material impact on the financial statements. So again, the auditor is making an explicit statement on your actual law and regulations in terms of that, your business, and in terms of your non-compliance. Now you can imagine if there has been non-compliance, how much words are going to go into the report that is now going to be much more open for the public in terms of when that goes onto Companies House. Fraud. A fraud statement is also in there now that will potentially be a lot harder as well. So we have to have objectives in there to identify and assess the risk of material misstatement of fraud and obtain evidence in regarding this. Design and implement responses. What you'll see on the next slide is that then things we have to put in place to show how we've done this. Again, this is potentially going in your audit report. I should add, by the way, I will get the slides to Simon afterwards if it's something you want to have a look at in more detail. And these are just pure examples. It won't necessarily be, this is not boilerplate in any shape or form anymore. Every audit report will look different. This is the bit that I think might shock some people. So we might have to put this in your accounts potentially. The audit team identified, and I've put in this example, the risk of management override and valuation of investments. It might be something else. It might be a bad debt provision. It might be impairment. Areas of which the financial statements are susceptible to fraud or misstatement. We then have to put the testing that we performed on those things to do with journal entries, evaluation of significant matters, unusual transactions, judgments, valuations. So as you can see, there's a lot of stuff going into an audit report now. And the key here is to discuss this audit report with your auditor so you know what's going in. It's management's gift to talk more about what you see the key risks of your business to be and what you see the risk of fraud, because again, they're going to be identified much more in your accounts. I think it's important that as finance professionals, that's something that is realised, because it's disclosure that for most won't have been put in unless you're in the listed market. That was probably it in terms of what I had in terms of the audit reports. I thought I'd just quickly move on then to audit pricing and tenders. You may or may not have been in the market. If you have been in the market, you'll know this. If you haven't been in the market, you won't. It is immensely strange times in the audit world, even without COVID. COVID has just made it even worse. There's massive, massive regulatory pressure. Kingman, Bryden, even the Waits report. There's lots of things out there that have been reviewed. That's mainly due to corporate failures, which you'll have seen out there. So we all know about Carillion. We all know about various cake shops that might have had issues as well. There's some massive ones out there. The auditor has been attacked in every single time on those. Now, there is a question down the line that will that switch to be more the directors? But ultimately, as we know in our world, people tend to go after the people that have resources or money to potentially pay fines. Why would you go after the director if the business has gone bust and they have nothing? People potentially wouldn't. So they're more likely to go after an auditor that's perceived to have bigger pockets. So what's that meant? The audit profession has therefore had to do things and had to change things. And arguably, some of those corporate failures probably were not fantastic and not great for our profession. But what that has meant in things like the Big Four, which we all know who they are, they'll have increased their fees a lot. They've exited work. you will hear some people have had fee increases of 50%, some even higher than that, in terms of, oh, your audit's starting in 2 months, by the way, the fee's going up by 50%. Clearly that isn't great. There's a lot of issue with resource, in terms of there's lots of recruiting happening in the Big Four, which puts pressure on the pool that's in the next tier down, in terms of ours, and even the tier down there. Therefore, that's price rises absolutely everywhere across the board for all your auditors. And that's without COVID, without going concern, without everything else. And as you will have seen in the audit reports, that's another reason why you will see fee increases. So if you're sitting there thinking that your audit fee will be the same as last year, if you've not had the discussion, unfortunately, I don't think it will be. It will go up. If you want to tender because you've had issues with your auditor, completely understand that. But a couple of things to think about. You need to get on and do this quickly. If you haven't started it, and you haven't done it within a good, I would argue, at least 3 months, if not more, maybe even 6 months before your reporting period, you ought to really start doing it. I know normally that isn't the case, but in the world we're in, you really do need to do it a lot quicker. So the key messages are, unfortunately, your prices will go up, and that'll be all audit firms. And if you need to tender as early as you possibly can, and expect some people to drop out because of resources, and make very clear that that's the question that you're asking to your firms. Can they deliver? So the conclusion really is, we're in a perfect storm. You've got deadline pressure, regulatory pressure, COVID pressure, furlough. We have had obviously illnesses as well, and we've got remote working. So from an accounting and finance profession, this has been hard for all of us. It'll been hard for your businesses. But from an audit point of view, work with your auditors, get stuff up front to them as quickly as possible. Hit some of these now bigger topics up front. Always hit your risk areas early. And nowadays, going concern, pressures on things like this are things that you have to put up front and not leave to the last minute. That's probably it from me. I just wanted to ask if there were any questions on this or anything else.
But we've had no questions come in. I've got a question for you though, Ben, based on what you just said. Do you think the length of audits is going to be extended quite a lot this year in terms of how much physically going to be in the businesses looking at them? Because it sounds like there's a lot more work for you to do.
Yeah, I think audits will be extended. I think that the bigger issue is the deadline piece, which is hence you put that up front. Audits are taking longer. Working remotely is hard, and most audit firms are working remotely. I think it's very unclear about when we can actually go back in the office. Looking at the stuff last night, in my head, I'm thinking going on site audits probably aren't going to happen back until the summer, which is a long time, and we're going to have a long period. It's delaying audits, it's delaying everything. So please do have conversations with your auditors around that, and particularly if you've got covenants or potential deadlines in contracts, I would really suggest that you get that done as early as you can with your finance providers as well, in terms of asking for extensions up front.
Thank you, Ben. Right, we've had no questions have come in, so I think the chat function's working. If you do have any questions, please feel free to type them in. I'll keep an eye on that for the next minute or so. Other than that, we will wrap up now. There will be a recording of this available, so if you do want to share this with any friends or colleagues, or you watch it again yourself, then I'll distribute the link within the next few days once we've got the recording available. I'll also distribute to everybody that signed up contact details, including Ben and Paul's contact details as well. So if you did have any questions or queries you want to discuss with them personally, feel free to. And also, if we can help with anything around your end, obviously we're accountancy and finance recruiters. So if you need any extra staffing to help out over a busy period, then please feel free to get in contact with me. So really, that just leaves me to say thank you ever so much to Ben and to Paul for your time this morning. I know you're busy at the moment, so thanks for sparing time for us. Thank you to everybody as well that's attended this morning and has been watching. So hope you've enjoyed it and found it as informative as I have. So we'll hopefully see you all again at our next event. Thanks again to our speakers, and enjoy the rest of your days.